Aditi, thanks so much for joining us. I just want to get your views right off the bat. How does this inclusion of India bonds in JP Morgan's emerging market bond index, how's that going to change credit markets in your view?
Good morning, Paul, and to all the viewers. It's a very happy morning for us because tomorrow India gets included in the JP Morgan EM index. It's a watershed moment for our country and a big milestone which India has been waiting to achieve. So tomorrow we're going to see that we get included, and this we anticipate will involve about $25 to $30 billion of investment coming into the bond market. This is going to be a big milestone because this will give exposure to the Indian GSEC market to the global investors in a fully accessible route. Do we expect any fireworks or anything dramatic happening in the next 1 week? My answer to that would be no, because this announcement came sometimes in September 2023. And as you also had mentioned, that people have been preparing for this. So we've been seeing that approximately $10 billion have already come into investment, and the rest is to follow. If we look at the composition of the index, India is going to be the second largest EM country into this index. 1% investment is going to happen on a monthly basis. So approximately we will take about 10 months to be completing this investment. And then we will be followed by inclusion in the Bloomberg index. So it's happy days and happy times for our country.
Yeah, as you say, this has been signalled for quite a while. We've seen a fair few inflows ahead of this happening as well. But to your point, how long do you think the market can sustain the interest of global bond investors?
So let me put it this way. There are about 27 securities which are par qualified. And since September 2023, I'm going to say, that we've been seeing the interest coming into 0 to 5 year bracket. But in off late, we've been seeing that there has been a duration play and people have been investing into the long duration. Is it a phenomenon of today or for next 6 months? I think putting a time period to it is not going to be fair, because we are expecting that after JP Morgan, then the Bloomberg index inclusion will happen, and post that there will be a more confidence from the global investors once they have seen and experienced India, that they will come down the credit curve. So I think that this is going to have a rippling effect over years, and I'm not even going to say months.
So what's your outlook for rupee corporate bonds? Can you see issuance rising this year? And if so, why?
So corporate bonds, I would say the domestic need is also quite high. So we have seen the record issuance number in the last financial year 23-24, and there has been a robust issuance starting this year financial year as well. Corporate bond has been dominated by the domestic investors, but in times to come, you will see international portfolio investors also investing in corporate bonds. But it will first start with the GSECs, which is what has already started with. We've already seen about $10 billion coming in. And eventually, we will see that going down to the corporate bonds, starting with the public sector undertakings and then going down the curve. But is this change imminent? We believe this change is imminent.
Well, you've got a number of online bond platforms emerging in India now. This is really sort of democratizing the investor base to a degree. What's your view on this? How is this deepening the corporate bond market?
I think this is first and one of the most important strategic movements done by our regulator, that is Securities Exchange Board of India. There are proper guidelines and regulations to be operating an online bond platform. It is governed by regulations and it is governed by our regulator. This gives us access to investors, apart from the institutional investors, to be investing into the fixed income asset. Today, fixed income asset has become a cornerstone of every financial portfolio. If we go on to the global footprint, we will see that you see bonds and NCDs appearing in most of the portfolios. This accessibility has given an investor an independence to make the investment within 5 minutes and be in control of their own portfolio. So this innovation and the support from the regulator has completely democratized, and I would say is a birthstone for the retailization of bond market.
So how much interest are you seeing from individual investors, and what sort of risks do they have to be aware of?
Okay. I would put it this way, the risk in a bond market remains common, whether it's an individual investor or an institutional investor. However, institutional investor is expected to be a lot more literate and lot more read and educated. All these bond platforms are putting in effort to educate the investor, spread the awareness for them to understand what the risk associated with fixed income investment is, which could be credit risk, liquidity risk, interest rate risk, to name the few. So there are steps being taken and there are proper guidelines how the disclosures needs to be made on these platforms for people to be aware before making the investments. However, we are seeing a lot of interest and inquisitiveness for people to learn. If you have seen the equity markets in India, the tech revolution, which gave the birth and was the reason for the robust Indian equity markets, is what is expected to happen in the Indian bond market. Also, an Indian bond market and revolutionization by investments coming from non-individual investors can be supported by the tech revolution that we are seeing.
We've also seen a widening in spreads between government and corporate bonds, and this is a trend you expect to continue. Can you help us understand why?
So we've been seeing the spread between the corporate bond and G-Secs to be widening for a reason that G-Sec has got included in the FAR, and we are seeing a continuous inflows coming in from the FPIs. And eventually, it will happen the same in the corporate bonds also. Corporate bond today, as an economy, and like every other global economy, there has been a volatility in the interest rates. So corporate bonds have been following the same trajectory. So hence, there has been I would say significant spread between the corporate bonds and the G-Sec. Hopefully, when we'll start seeing the more money coming from the FPIs in the corporate bonds and more predictability and the stability in the interest rate scenario, we will see that spread to be contracting.